Welcome to this presentation on a very important tax compliance issue faced by many salaried employees, situations where the employer deducts TDS from salary but fails to deposit it with the government. In this presentation, we will understand how salary TDS works, what risks employees face when employers default, the legal protection available, and the practical steps employees should take to safeguard themselves. This presentation is brought to you by JL&R and Company Chartered Accountants.
Let us first understand what TDS actually means. TDS, or tax deducted at source, is a system where the employer deducts tax directly from the employee's salary before paying the balance salary amount. The employer is then required to deposit this deducted tax with the income tax department on behalf of the employee. This mechanism helps the government collect taxes regularly throughout the year and also reduces the burden on taxpayers during return filing season. However, many employees assume that once TDS is deducted from their salary, their responsibility is completely over. Unfortunately, that assumption may not always be correct. If the employer deducts the TDS but does not deposit it with the government, serious complications can arise for the employee. To understand the problem clearly, let us look at the normal TDS process flow. First, the employer deducts TDS from the employee's monthly salary. Second, the employer deposits the deducted tax amount with the government within the prescribed due dates. Third, the employer files quarterly TDS returns using Form 24Q. Fourth, based on these filings, the employer issues Form 16 to the employee. Finally, the TDS credit reflects in the employee's Form 26 as. Every step in this chain is important. If even one step fails, especially the deposit or return filing stage, the employee may not receive TDS credit in Form 26s, which can later trigger a tax demand notice. Now let us understand the actual problem scenario. The employer deducts TDS from the employee's salary, reducing the employee's take-home pay. But instead of depositing that tax amount with the government, the employer either delays it or completely fails to deposit it. As a result, the TDS credit does not appear in the employee's Form 26 AIS or AIS. Later, during income tax processing, the employee may receive a tax demand notice because the department considers that tax as unpaid. The most frustrating part is this: the employee has already borne the tax burden through salary deduction, but due to the employer's failure, the employee still faces compliance issues. Unfortunately, this problem affects thousands of employees every year. There are several reasons why employers fail to deposit TDS. One common reason is financial stress. Some companies facing cash flow shortages temporarily use TDS funds for business expenses, intending to pay later, but sometimes they never do. Another reason is negligence, where poor accounting controls or lack of compliance monitoring causes missed deadlines. In some cases, there may even be fraudulent intent, where employers deliberately deduct TDS but never deposit it. Errors in TDS filings can also create problems. Incorrect PAN details or challan mismatches may prevent proper credit reflection. Seasonal businesses and companies facing liquidity problems may also delay statutory payments. Regardless of the reason, the employee ultimately becomes the affected party. Employees should remain alert for early warning signs. The first red flag is when TDS deducted from salary does not appear in Form 26 AIS or AIS. Another warning sign is delay or non-issuance of Form 16. Employers are legally required to issue Form 16 within the prescribed timeline. Sometimes, only partial TDS appears in Form 26 as. This may indicate that the employer deposited only part of the tax amount. Employees should also be cautious if the HR or accounts department avoids responding to TDS-related questions. Ignoring these signs can create bigger issues later during return processing. Fortunately, employees can independently verify their TDS status. The most important tool is Form 26 AS, available through the Income Tax Portal or Trace's website. Employees should compare the TDS reflected there with their salary slips. Another useful tool is the Annual Information Statement, or AIS, which provides a broader view of income and tax records. Employees should also regularly compare monthly salary slips with cumulative TDS credits appearing online. Form 16 should always match Form 26 as. Any mismatch should be investigated immediately. A good practice is to check Form 26 AS every quarter instead of waiting until the financial year ends. Now comes the most important relief for employees. Indian courts and tax tribunals have repeatedly held that a genuine employee should not suffer because of the employer's default. If TDS was genuinely deducted from salary, the employee cannot normally be forced to pay the same tax again. Under Section 205 of the Income Tax Act, once tax has been deducted at source, the responsibility shifts to the deductor, meaning the employer. However, employees must be able to prove that the deduction actually happened. This is why documentary evidence becomes extremely important. Employees should maintain a strong documentation file. First, preserve all monthly salary slips showing TDS deductions. Second, maintain bank statements showing the reduced net salary credited after tax deduction. Third, keep Form 16 safely whenever it is issued. The appointment letter or employment contract is also useful because it establishes the employment relationship and salary terms. Additionally, preserve all email communications with HR or finance teams regarding salary, TDS, or Form 16. These documents become critical evidence if any dispute arises later. If employees discover a TDS mismatch, they should act systematically. Step 1 is to formally contact the employer and request confirmation of TDS deposit and issuance of Form 16. Step 2 is to collect all supporting documents such as salary slips, bank statements, and screenshots of Form 26 as. Step 3 is to file the income tax return carefully and claim the TDS credit, even if it does not appear in Form 26 AS, while maintaining proper evidence. Step 4 is to respond promptly to any tax notice received from the department. Finally, employees may raise a grievance through the income tax portal or approach the jurisdictional assessing officer if necessary. Timely action is extremely important. If you receive a tax demand notice, do not panic, but do not ignore it either. First, carefully read the notice and understand the section under which it is issued, the amount demanded, and the response deadline. Second, compile all supporting documents proving that TDS was deducted from your salary. Third, submit an online response or rectification request through the income tax portal with all supporting evidence. And fourth, seek professional guidance from a chartered accountant or tax consultant if needed. One very important point: do not immediately pay the demand simply to close the matter. Payment may sometimes be interpreted as acceptance of liability. The law imposes severe consequences on employers who fail to deposit TDS. Under Section 201, 1A, interest is charged for delayed payment of TDS. Under Section 271C, penalties equal to the unpaid TDS amount may be imposed. In serious cases, Section 276B provides for prosecution and even imprisonment for willful failure to deposit TDS. The employer may also be treated as an assessee in default and face scrutiny assessments, tax audit complications, and disallowance of expenses. These provisions clearly show that the legal liability primarily rests on the employer. Prevention is always better than litigation. Employees should verify Form 26AS every quarter after the TDS deposit due dates. If any mismatch is noticed, the issue should be escalated immediately instead of waiting until the end of the year. Maintain a proper digital and physical folder containing salary slips, Form 16, bank statements, and tax records for at least 6 years. Employees should also enable email and SMS alerts on the income tax portal to stay updated about notices and tax information. Regular monitoring significantly reduces future complications. Let us address some common questions. First, can an employee be taxed again if TDS was deducted but not deposited? Technically, the department may raise a demand initially. However, courts have generally protected genuine employees who can provide documentary proof. Second, is Form 16 alone sufficient proof? Form 16 is strong evidence, but even if it is unavailable, salary slips, bank statements, and employment documents together can support the employee's case. Third, what happens if the employer disappears or shuts down? In such cases, employees should approach the jurisdictional assessing officer and submit all available evidence. Additional legal remedies may also be explored depending on the circumstances. Let us conclude with the key takeaways. First, awareness is essential. Employees must understand how TDS works and monitor their tax credits regularly. Second, continuous monitoring helps identify problems early before notices are issued. Third, documentation is your strongest protection. Proper records can help defend your position legally. Remember this simple formula: awareness plus monitoring equals protection. A vigilant and well-documented employee is far better protected against employer TDS defaults. Thank you for your time and attention. We hope this presentation has helped you understand your rights and responsibilities in cases where employers fail to deposit deducted TDS. If you require professional assistance regarding TDS mismatches, tax notices, or compliance support, feel free to contact JLNR and Company. Chartered Accountants. Stay informed, stay compliant, stay protected.